Please welcome to the stage, Neil Woolard.
I was wondering if people were going to clap after seeing that. It felt like that was right, huh? Well, I want to welcome all of you to the 4th annual True Wealth Live. My name is Neil Woolard. In case you just missed it, I'm a wealth advisor here at Creekmer. And I want to express on behalf of all the staff, we're so glad you made the time to come out tonight. And for those of you joining us on the live stream, we're so glad that you're here. This is one of the events we do in a series of events that's intended to help encourage, educate, and empower our clients. I want to let you know about a couple other events coming up. On June 26th, we're going to have an introduction event. This is going to be at the Creekmer's personal home. There's going to be a lot of food, a lot of people. It's going to be a good time. And it's intended that if you have any people that are like yourself who think could benefit from our services, it's just an easy way for you to bring them, a low-key way to do an introduction. Also want to let you know on July 3rd, we are going to be having the annual July event. You'll be able to see more information on the website about that. We would love for you to sign up for that. Just call into the office or go to the website. We'd love to see you there. As far as tonight is concerned, I just want to draw your attention to 3 things that I think you'll want to know. First, restrooms. Closest restroom is around the corner, around the way. For those of you on the live stream, I'm just going to trust you know where the closest restroom is. Additionally, if you see in front of you, you'll see some papers here and a pen, and there's going to be a little blue referral card. The back sheet of paper just explains some of the services that we offer, because sometimes we just get used to talking to whoever your advisor is, and you don't realize all the services we have. But in particular, I want to draw your attention to this paper right here. So if you can find it, look for it. And what you'll see is you can enter your information, and at the end of the night, we want to collect one of these from everybody. So this is a live event, not only because it's on the live stream, but because we actually want to interact with you through the evening. So if you can see, there's blank spaces there, 1, 2, 3. As we go through the evening, there will be some action points where you can take control of your finances and take a step forward to increase your confidence and security. So just write it down there. For those of you on the live stream, you can just write down a couple things on a pad, a paper that you have next with you, and this QR code right there. If you click on it, you could set up an appointment with us. So we're going to collect these at the end of the night. Mackenzie, are you here? Can everyone see Mackenzie? If you can give your paper to Mackenzie or leave it on the table, that would be great. Now, the other way that we want to interact with you tonight is through giving you the opportunity to ask questions. So we're going to put this phone number on the screen, and if so, I'm going to ask that you go ahead and write down this phone number, 309-925-2043, because at the end of the night, John is going to answer any questions that you send in. And we would encourage you, don't wait to send it until the end of the night, but go ahead and begin sending that as you have any question. And then John will answer all the questions that he can, and if he doesn't get to your question, we will follow up with you afterwards. So those are the 2 ways we want to interact with you tonight, this form and texting, and I encourage you to use both of those. Tonight, John Creekmur, our founder and owner, he's going to take some time, review and look past at the last year, but then also look forward and help us think about how to navigate through these turbulent waters of today's market. What John's going to do tonight actually reminds me of an experience I had in Astoria, Oregon. At the time, I lived in the area, and I had to go visit Astoria because if you know the movie Goonies, that's where it was filmed. So I had to go see that. And when we got there, I realized it's a small port town right where the Columbia River meets the Pacific Ocean. And we had a dinner that night that turned out to be quite an educational dinner because it sat out on the water. And as we looked out on the water, we saw these huge freightliners coming in from the ocean just lined up. Each of them, $100 to $500 million worth of cargo in it. And I couldn't think, why are they waiting there? They're not unloading. So I was curious, and I asked our server about that. And it turns out that they were waiting for what they call the Columbia River Bar Pilot. So that port was notorious for having these treacherous waters. The waters looked calm on the top, but underneath there were currents that were unpredictable. Shoals were always shifting. Water depths were always shifting. And the one job of this pilot was to make sure that he took that boat, he led that boat through the treacherous water, which, I mean, kind of makes sense. If you have something that is that valuable, that you need to move through water that is that turbulent, I mean, wouldn't you want someone who knows what they're doing and have been through the waters before? I mean, tonight is the same thing. You have something of great value. You've trusted Creekmer with your life savings. We don't take that for granted. But it can be nerve-wracking a little bit to look around and see, I don't know if you've noticed, the turbulent nature of the markets that are happening right now. And we can't really sit back and be passive. No one wants to be that driving that ship and into the shore. No one wants to learn the hard way what happens if you don't have someone lead you through well. So that's where I want to introduce to you our speaker tonight, John Creekmer. He's been around. He knows what he's talking about, and turbulent waters is nothing new to him. He's lived and breathed economy, finances his whole life. As Stacy has said so often, John was the only freshman student to bring a Wall Street Journal into high school. And then he continued studying. He earned a bachelor's of accounting and finance at Cedarville University. He earned a master's in business administration. He's a certified financial planner. He's been in the industry for 35 years. He started Creekmer 30 years ago. And even today, there was a new article that came out that placed Creekmer in the top 250 registered investment advisors in the nation. That is John's leadership. If you've sat in a meeting with him, you know you typically learn a little something small. You know that he's led people and helped people through the dot-com bubble of 2001, through the housing market crisis of 2007. It's clear that he's been around. But now we're starting to get to the point where we're not the only ones that benefit from John's expertise. We're starting to see him pop up nationally quite regularly. His book, Your Blueprint for Purpose, bestseller on Amazon. It's becoming common to see him on national news sources like Barron's, Bloomberg, MSNBC, CNBC, Fox, Forbes, Yahoo Finance. It's becoming normal to see him, but that's because he knows what he's doing, and turbulent waters are nothing new to him. But I think a lot of you in this room might be like me. I didn't meet John seeing him talking on a national news show. I first heard about John from my brother and sister-in-law from a distance. John was their elder, their leader at their church, and he had the reputation of being the elder who listens and who really cares. And when I first talked to John, I had my first lunch with him, I learned a lot of things. First of all, he's kind of funny, you know? He's not boring to be around. That's great. But then as I talked to him, I found myself giving him my life story, like the long version of it. And I found that's actually a pretty common experience because they care enough to ask questions and to listen. And I heard the way he started talking about his wife, his kids, his grandkids, the way he started talking about his employees, the way that he started talking about you, his clients. John is someone who cares, and that is filtered down into this company. If you've lived enough life, you begin to sniff out if someone is for real or not, if they care or not, and it's clear that John cares. He really cares. So if I could introduce him, the best two things I could say about him is he knows what he's talking about, and he cares. Like, he really cares. So because of that, don't be bashful. Don't be shy about texting in those questions. He's the guy you want to ask. And as well, don't be bashful about filling out these forms. We want to help. That's what the purpose of this night is. And so I hope you came here ready to listen, ready to learn, ready to make a difference in your own financial security. In just a moment, we're going to watch a video that sets the tone about the turbulent markets, the turbulent environment we're in, and then John's going to come up and talk to you briefly.
And so if we see tariffs actually take hold, at this point, we know they're being used as negotiating tactics, and it may end up being a longer-term hold as far as tariffs, which we did see President Trump use that tactic in his first term.
I think it's really presumptuous, even in the end of last year, to really forecast 3 to 4 possible increases in 2020 5, and we're seeing really kind of a change and a moderation in that. And right now, really wanting to try to get our inflation rate back down and get it back toward that target the Federal Reserve has kind of been looking on for the last number of years, that 2% level.
Okay, so at this point now, if this is a textbook sort of pullback correction, whatever you want to call it, does it present opportunity?
Definitely presents opportunity. It depends on where we're looking at. So, right now, as far as an entire market cycle, and we think whenever we have a change in administration from one philosophy as far as in a platform to another, there's a period of time of readjustment, and that usually takes somewhere between 6 to 9 months, and we're kind of right sitting in the midst of that, or at least in the early stage of that.
So what makes you so sure that there's not more pain to come?
Yeah, so we definitely see pain to come. The question is how much pain to come. So at this point, we're really seeing about a 16% pullback in the cards from where things sit right now. We know the pace of a correction typically is a little bit faster, and we know that the length of time of correction lasts 4 to 7 months.
We have John Creekmur, Chief Investment Officer at Creekmer Wealth Advisors.
John Creekmer is with us, Chief Investment Officer, Creekmer Wealth Advisors. Thank you for being here.
And John Creekmer, Chief Investment Officer at Creekmer Wealth Advisors, joins us.
Let's bring in John Creekmur now, CIO at Creekmer Wealth Advisors. John, thanks for your time.
Got Chief Investment Officer for Creekmer Wealth and Advisors, John Creekmer, here with us.
Please welcome John Creekmer.
In any war, before a bullet is fired, before a bomb is dropped, you can look back in history and you can usually find a policy decision brought about by a government, and it may have been decades earlier, it may have been 5 decades earlier, but that policy decision has impact for many years to come. An example. In the year 1870, in Japan, they went through what was called and initiated the Meiji Revolution or Restoration. That was an intentional political decision to take Japan from an agricultural society that was rule-based into an industrialized society. Their plan was based upon what they saw happening in the United States of America. If anybody saw a film 25 years ago called The Last Samurai of Tom Cruise, that was right after this began. Well, why is that significant? Because in order for them to have industrialization, in order for them to have manufacturing that would allow them to build and expand their economic base in their society, they needed natural resources. As an island nation, they were limited at that period of time with the natural resources that were available to them. So over the course of time, into the early 1900s, into the 1920s, the 1930s, Japan started going into other neighboring countries with military force to be able to extract the natural materials that they needed to be able to continue to expand their industrialized society. In the 1930s, the United States of America started putting pressure on Japan that they should not be using military force to be able to expand their industrialized society. Instead, they should use negotiations. The United States of America, in these negotiations, they actually started to threaten to exert political military force to slow them down and cut down shipping lanes. That led to the United States of America being viewed as being distracted by what was happening in mainland Europe with the stopping of Adolf Hitler. Japan saw an opportunity because the biggest blockade to keep them from being able to go into the shipping lanes, control the shipping lanes, and expand their base was the U.S. Navy that was stationed in Pearl Harbor. Another time period, July 2nd, 1944, over the course of 3 weeks, World War II was coming to an end. As it was coming to an end, 44 nations came together in Bretton Woods in New Hampshire. It's called the Bretton Woods Conference. And what they were focused on doing was setting up an international economic system that would allow the entire world to come out of World War II at a much faster pace, but in a more organized way. Out of that came the current iteration of the World Bank, International Monetary Fund, but something more significant happened. This one decision, agreed upon by 44 countries, was the impetus to drive the United States economy into being the largest, most profitable, strongest economy in the world. What was that decision? Back then, the currencies of the world were pegged to the gold standard. Anybody hear that? The dollar was pegged to the gold standard, but the issue is, how would the transactions in the world get executed? So what they decided to do was to make the US dollar the reserve currency of the entire world. That single decision provided the economic foundation to drive the growth in the United States economy over the last 80 years. Stacy and I, a couple years ago, we were in Mexico, and we were sitting on the beach and kind of laying back in our chairs and having a great time and enjoying ourselves. The person sitting next to us had come off a cruise ship, and they were from Germany. The person coming up to serve them was from Mexico. The Germans spoke no Spanish, or Mexican, or Mexicali, or whatever the dialect of the day was in Cabo. But also, it's interesting, the server spoke no German. So the German was trying to order his beer. The Mexican, the server, did not understand what was being said, so they're speaking in their two languages. Stacy and I almost started laughing because what did they resort to? They both went to their second language. Their second language was English. So they used the English language for the fellow from Germany to get his beer, for the server from Mexico to get his tip. Everybody went home happy. Let's say we have two small countries. Let's say we have Cambodia, and Cambodia is needing to sell some goods over to Peru. Whenever they go to sell those goods, how do they transact that in what currency? The goods are actually priced in dollars, and in most cases executed in dollars. Why is that? It is the largest, most liquid currency in the world. It is the currency that countries are used to exacting trade on. It made America powerful. Whenever we look at things that are going on today, we need to look back and say, what does this have to do with history? How did we get here? So when we talk tariffs and we talk trade, we need to recognize there's more at play than simply tariffs and trade. We know that in economic systems of the world, Ray Dalio put out a study 3 years ago in which he lays out that the economic powers of the world, going down through thousands of years, last approximately 250 years. We know that every approximately 80 years, there is a reset in society. Why 80 years? Because at 80 years, you typically see 4 generations in a family alive at the same time. But 10 years later, the oldest generation passes away. Now we have a new iteration of 4 generations. So we look back at it, 250 years ago, next year, we celebrate the 250th anniversary of the signing of the Declaration of Independence. What about 80 years ago? 80 years ago, 81 years ago now, was the signing at the Bretton Woods Conference to make the US dollar the reserve currency of the world. So it's not just about tariffs, it's not just about trade, it's about truly making decisions that have long-term impact for the next generation. Today, we're going to focus on 3 E's. We call that Ecubed. Number 1, we're going to focus on education. We're going to walk through what happened in 2024. We're going to explain what happened so far in 2025. And we're also going to go over projections for the rest of 2025. As we're walking through this, I'd like to set a couple ground rules. So a lot of what we've experienced so far in 2025 has to do with policy decisions that are being made in Washington, D.C. So, as a wealth advisor, as an economist, I am agnostic. And so, at our firm, we may have individually strong views one way or the other. Did you see what I did there? One way to the far right, one way to the far left. We may have views. In our role to give you counsel, we are agnostic. Today, we'll be talking about things from an academic perspective. So if you go home and say, hey, I think John believes this politically, here's his position, just know you misheard what I was saying. So we're going to walk through things from an academic standpoint. One of the things that I appreciate about our firm as we continue to get larger is we have a lot of people from a lot of different life experiences and backgrounds. However, we have an environment that is collegial, meaning we sit and discuss topics of the day from different perspectives in order for us to get to the best vantage point to make sure we understand what every situation is. Today we're going to educate based upon facts. Number two, we're going to encourage. We're going to look past the headlines and we're going to focus on your goals. And so we're going to educate, we're going to encourage, and lastly, we're going to empower you. We're going to give you actionable takeaways of which you can have tools to accomplish the goals. We're going to say, let's look past the headlines. We're going to talk about some psychology. We're going to talk about food. We're going to talk about ways I embarrass my wife, and that's all good. But we're going to walk with a goal to educate, encourage, and empower you. About a month ago, Drew received an email from a client, and it said, what in the world is going on in the markets? And I don't know if anyone else has had that thought. What's going on in the markets? It's a big question. And this particular individual was planning on retiring this year. But because of the uncertainty in the markets, started questioning that decision. Should I be doing that? The number one question I get whenever I'm being interviewed on TV, and we're being asked for our opinions a lot more, because not just me, the writings of our Director of Financial Planning, Clark Randall, is a phenomenal academic resource, and Drew is the Director of Advisory Services, getting published, being asked to assist in development of technology and in the development of resources for large firms. So we're being asked for our opinions at a larger and larger scale. In the last month, some version of this question is what I get asked the most. What's going on? And I believe the reason why people like to ask that is they recognize that we are not partisan in our view. We truly look at things from an academic standpoint and lay out, here's what's going on at this moment. We know it can change tomorrow. Here's some ways to view through things. This year, on April the 2nd, we had what was it called? Anybody remember what it was called, April 2nd? It's called Liberation Day. Okay, that was the name, and so it's called Liberation Day. And we know that President Trump, throughout campaigning, he says, I love tariffs. I love tariffs. So he talked about it all through January, February, and March. In the first 100 days of his presidency, he has moved at such a fast pace at implementing his agenda and the agenda that he holds to. And one of the things that came out on April the 2nd was instituting tariffs. And then all of a sudden, in short order, there was a pause on the tariffs. Why was there a pause so fast? And what's so interesting is, I believe there was pressure to pause because of the impact. It is our belief from an academic standpoint, there was things that were happening that caused a lot of instability in the large financial markets of the world, not the U.S. stock market, but the bond market and the currency markets. That caused the pause. So what do you mean? From March the 24th until April the 7th, the S&P 500 was down 17.27%. It was down over 10% in 2 days. It actually touched from the high, we briefly touched down 20%. So 20% pullback is the beginning of a bear market. However, academics, there'll be truth in time, will say, was that really the beginning of a bear market? It's only lasted for 1 day. So we'll have to see how that plays out in time. So when it drops down, people view the stock market as a risk asset. There's instability. What's going on? A lot of things happening. We seem to be changing direction continuously. So people say, the premium I pay for this stock, the price I pay for this stock, there's too much risk. I'm going to sell out of that risk asset. When people sell out of risk assets, they look for safety. Historically, people will look for safety in three areas. They look for it in U.S. government bonds, they look for it in U.S. dollars, and they look for it in precious metals such as gold. We look back in history. When this day happened, the price of gold exploded higher. What's interesting, though, is that in 2020, gold only went up a little bit, even though the U.S. stock market dropped by 37%, and also the bonds went up as far as in value. In 2007 through 2010, we saw the exact same thing happen. Initially, gold went up, and then it kind of settled back down, but bonds and the dollar both went up. 2000, 2002, the exact same scenario. Gold went up a little bit, then it settled back down, back to the inflationary target. However, U.S. dollars and U.S. government bonds went up. We all have heard about the U.S. government debt. The U.S. government is the largest issuer of debt in the world. We are quickly approaching $37 trillion, but also we have the largest and most liquid currency in the world. So why would people go to U.S. bonds for safety? It's because the U.S. government and our country, the United States of America, is viewed worldwide as the safest economy in the world, the most stable economy in the world. The U.S. dollar is the reserve currency of the world. So if somebody has U.S. bonds and they sell them, what are they going to get back? Dollars. So historically, we have people selling stocks, and what do? They put their dollars into bonds. There's a limited number of bonds. When dollars go into bonds, demand is higher. Price goes up. If price goes up, interest rates go down. Within this week, interest rates on the 10-year Treasury went from 3.88% to 4.5%. It is the fastest increase of 10-year Treasury rates in history. So then they must have said, people said, well, obviously they're going into dollars for their safety. If we take a basket of all the currencies of the world and we peg them against the U.S. dollar, the value at the end of March, on March 24th, was at 110 to 100. That was the conversion rate. 3 days after the tariff started, the dollar had dropped from 110 to 88. So what does that mean? Some people speculate. They say, well, it's got to be China. China's then firing their own salvos. And China is the second largest holder of U.S. government debt at approximately $750 billion. There's no indication anywhere that you cannot find trade transaction reports. We cannot find any history. We cannot find any orders of any large sales of U.S. government debt from China. What about Japan? Japan is the largest holder of U.S. government debt at $1.07 trillion. Obviously, those two work together to sell bonds to put pressure on the U.S. government. There's no evidence of that. Instead, the theory is that global investment managers, global banks, in the short term have lost confidence in the stability of the U.S. financial system. If you're asking yourself, why was there a 90-day pause, it was because of the U.S. bond market and the U.S. dollar. That has huge impact. 2024, S&P 500 is up 23%, the NASDAQ is up 29%, and the Dow Jones Industrial Average was up 13.25%. It was a great rate of return. Your personal investments would have done better or worse than that, depending upon the risks that you had inside your accounts. So we know it was a great year as far as the markets being up. That was fueled by 7, it's called mega cap names. Those 7 companies accounted for 59% of the stock market's total return that year. So let's do simple math and take 23% times 60%, and you're going to recognize 13.8% of that total 23% rate of return was tied to the movement of 7 companies. Apple, Microsoft, Google, Amazon, NVIDIA, Meta or Facebook, and Tesla. That pushed the rise last year. Let's just say we're looking at the 504 companies in the S&P 500. If you said the median, right here in the middle, was right here, and the market's up 23%, well, then you would say there's equal number of those companies that outperformed and those underperformed to get us to 23%. Over 35% of all the companies in the S&P 500 were negative that year. That's staggering. So what that means is a small number of names drove the market higher. But why is that? 2024 was the year of artificial intelligence. I don't know if anybody sees any similarity from that guy to me. Artificial intelligence is transformative technology, and it captured everybody's imagination. It even captured Victoria's imagination when she knew I was wearing the suit today with this shirt and this tie, and she had a picture of it, and she put in artificial intelligence to make a comic book character of John. That's what we get. That's transformative technology. Or on February 14th, I said to ChatGPT, please write for me a text message for my wife of 35 years to tell her how much I love her and how beautiful she is. So it gave me a wonderful prose that I was able to put down and send in a text message to her. And she's like, doesn't sound like you. What are you doing? I thought I had found Cyrano de Bergerac, but it was not the case. However, this prompted talk of a bubble. So what's a bubble? A bubble is when all of a sudden a stock price, or the price of a commodity, or the price of art, or the price of tulip bulbs gets so high that it's not sustainable. It's going to pop. It pushed valuations so high. Well, how high did it push it? This is the S&P 500. It's called Cape-Shiller ratio. It's something that I've been tracking for my entire career. This is price per share over earnings per share, indexed for inflation. A lot of words. So let's just say that you own a stock. It's $100 a share. Let's say that company makes $5 a share. It would have a ratio of 20. So in simple terms in your mind, you would say, well, if they're making $5 a share over the next year, and I'm going to pay $100 for that, it's going to take me 20 years to get my money back as far as in earnings. Okay? So this chart is so fascinating. So remember correctly, we had these names here. S&P up 23%, fueled by 7 names. It prompted the thought of a bubble. What's a bubble? It's that chart. Last year at the end of the year, right now we're sitting at 31.86 as far as the ratio. At the end of the year, we were sitting at the 3rd highest valuation in the history of the U.S. stock market. The 3rd highest. We were sitting at about 37.8. The second highest time was in February of 2020, right before COVID happened. And we know what happened. We had a 37% drop over the course of 30 days. The next highest time was December of 1999, after the tech boom. So valuations got so high, all it took was for a sneeze to happen. So think about it. What happened in March of 2020? A sneeze happened, or a cough happened. COVID. So valuations are high, something happened, stock market crashes. 2000, January of 2000. Valuations the highest ever at 44. A sneeze happened. What happened? All of a sudden, the tech got too far ahead of itself. They started seeing a little bit of a sell-off. We go into a recession. We then had September 11th of 2001. 3 consecutive years of the stock market going down. Remember this chart? I'll talk about more later on. Otherwise, the 4th highest time, if anyone can see those dates, was December of 1929. So those are 3 times. We don't say history does not repeat itself. It simply rhymes. Okay? So those are 3 times where the valuation got high, and then bad things happened in the equity market. So something happened, something triggered. And if anybody is a fan of 1980s movies, and you love watching Ferris Bueller's Day Off, lesson that I learned, if you're watching the movie release version of Ferris Bueller's Day Off and you have your small children in the room watching with you, I would encourage you to turn the volume down. There's a lot of foul language, which I didn't recognize when I was 15. But remember the scene in social studies when Ben Stein is the teacher, And he has that classic line, anybody, anybody. What was he talking about? The tariffs that came out in 1929. Okay? And so we see things that happened back in history. Now, those were very extreme. They were very longly held. And so they were a little bit different. However, what we cannot get away from is high valuation, something sneezes, something costs. A black swan event happens. And what does black swan mean? Typically, swans are white. Every now and then, you'll see a black one, like over in Bruges. Bruges is beautiful canals. You go in and get your chocolate, great place for chocolate and pastries. You go and sit there and you watch black swans swimming. It's so unusual to see them. It's like, I got to watch these black swans. It's something unusual in time and nature and history. A black swan event happens September 11th, market pulls back. I want you to take this chart and remember it. And we're going to go into it, Connor, a little bit later on tonight. This is the psychology of a market cycle. Mr. Wyckoff wrote this back in 1925-26. He was a great economist. We follow a lot of Wyckoff's writings and teachings, even though it's 100 years old. That means it's tried and true. It's stood the test of time. Whenever a stock or a stock market starts going up, it comes down, we have disbelief. Then all of a sudden it moves back up, there's hope. Then it moves up a little bit more, now there's belief. It goes all the way up, and we have euphoria. That's when a bubble happens. That's artificial intelligence. Then all of a sudden it comes down, and it's like, oh my goodness, it's going down. We get anxious. Then it comes down a little bit more. I'm in denial. Stock market, by the dip, it always goes back up and to the right. I can't believe it's going down. It's going to come back up. Then panic sets in. Then the word called capitulation. That's where, oh man, that's when you hear the phrase, people were jumping out of the third floor window and during the great crash of the 20s and 30s. Threw the baby out with the bathwater. People just sell stuff for no reason at all. Besides, I can't take it anymore. Then there's anger, depression, and then disbelief, and it resets. 2025, the financial landscape is impacted by four things. We're going to go over all four of them, and we're going to talk about why it's impacted us. The first one is President Trump, which I do love this little graphic here. You see his hair? And so then we have trade and tariffs, we have taxes, and we have turmoil. Those are the four T's that are impacting us today. Now, are they going to be impacting us negatively short-term or long-term? There's truth and time on that. And I know if I choose to predict how long it's going to impact us, I'm going to be wrong. So instead, I'm just going to walk through what the impact is and what the facts are. President Trump, who came into his second term in office, elected in November of last year, 2024, came in January the 20th, he has a number of policy statements that he's focused on. Good, bad, right or wrong, agree, disagree, that's each of us to hold to. But we do know that policy decisions impact all of us, and sometimes good for short periods of time or good for long periods of time, sometimes painful for short periods of time, but good for long periods of time. And so this is a sidebar discussion that we can have to kind of walk through our thoughts on that. But we know immigration reform and border security is a high priority as far as in his campaign. America First economic policy, again, high on the priority. Think back to what I was saying in 1944. We have Bretton Woods. Fast forward 40 years later. We're now in 1982. 1982, President Ronald Reagan and Prime Minister Thatcher from England, they together ushered the economies of the world into something called neoliberalism. That actually accelerated the free trade philosophy. We're walking through that today, dealing with those issues today. So that was a policy decision made 40 years ago. It played out in time, and maybe it was good for a season, maybe it pulled us out of a recession, maybe it helped reset unemployment issues that we were having very high unemployment of 18 and 19%, inflation in the late 70s, early 80s was going in high teens. Neoliberalism helped pull us out of that. However, applied to extreme measures, put us in the environment where we are today. Foreign policy and national defense. These are the four primary legs to the stool of President Trump's agenda here for the first 100 days. Tariffs. April 2nd, 2025 is viewed or is mentioned as been named Liberation Day. At that time, there was a 25% tariffs on most imports from Canada and Mexico. And then you could say, well, is that an economic position, or is that really to go through to accomplish one of these other of the 4 pillars? Okay, so 10% tariff on most all countries. China's tariffs are now up to 145%, unless that's changed, and it changes every day, it seems like. However, tariffs from China on U.S. goods is at 125%. When you think about a tariff is a blunt instrument. Okay? It's useful as a tool, the same way that I know that I have my desk at home, and I need to get a hole in that desk because I need to run the cords from my TV through the desk and get to be able to plug in the wall. So I can get my large hammer and I can bang on that and I can put a hole in that. Well, I accomplish getting the hole, or I can get my drill, I can get a circular drill bit and I can put the hole, I make my 1-inch diameter, put the hole in. That's a sharp instrument. Tariffs should be viewed as a blunt instrument to accomplish economic and policy objectives. That's what a tariff would be. Economic, as far as in the short term, is not as pronounced for the overall economy. However, the longer that we have tariffs at elevated levels, that does have a longer-term economic impact. I would encourage you to set your mind to say, for every month that we have a higher than normal tariff policy that's reciprocal between countries, it has about a 6-month impact on the economy. So it's longer term. The International Monetary Fund released last week that they have decreased the expectation for growth, GDP, in the U.S. economy over the last month from 2.8% to 1.9%. Significant decrease. They say that their decreases came just because of the current tariff environment of countries of the world going back and forth. Could that be a long-term tool? Could it be a short-term tool? We'll have to see how all that plays out. There's negotiations going on already, as we know, and we'll see how that plays out. That has caused the instability in this year. Taxes, expiration of the 2017 Tax Act. This is a big deal for this year. There's already negotiations going on. If they're set to expire, I've looked at 3 returns, of which the preparation company and the planning company had taken the client's 2024 facts, their income, their interest and dividend, their IRA deduction, their itemization, their standard deduction, whatever applied to them. They took the 2024 return. They took the exact same information, but they applied it to the rules from before 2017 law was passed. In all 3 of them, the average increase in taxes on the exact same set of facts was right at 20%. So in other words, if you paid $5,000 in taxes last year, if they do not find a solution for this expiration, it'll be $6,000 next year. If you paid $10,000, it'll be $12,000. Every situation is unique. There's a number of things that are happening here. So number 1 is proposed elimination of the federal income tax on Social Security benefits. This has been a big discussion for decades. Why am I being taxed on my Social Security benefits? I'm being taxed on the refund of a tax. And so when you think about it from a logic standpoint, there's a lot of truth in that. And so there's a discussion of a proposal to eliminate federal income tax on Social Security benefits. There's also being floated around in Washington, and I think there might be a little bit of legs to this, that we're going to go ahead and we're going to make some changes. We're going to have this be extended on for another 10-year period of time. However, in the negotiations, the Republican Party has always been known as the no-tax party. Right now, there's actually certain elements of the Republican Party that are talking about increasing by 2 or 3 percentage points the highest tax bracket from 37% to 39% or to 40%. And they're saying we're going to cap that at maybe $1 million or $2 million of income. Anything above that will be taxed at that. That is a huge, huge, huge shift in philosophy. But we do know President Trump did win on a populist message. So the problem is we don't know all the changes that are going to happen. And we're not going to know until the fourth quarter. We're also not going to know if it's going to be retroactive until 2025 tax year, or if it's going to go forward in 2026. But why would it be retroactive? Because the 2017 law was retroactive 2016. So taxes, instability, this is a big deal. We'll tell on that a little bit later on. And then turmoil. This is, you see the chart where it drops off there the first part of April. The reality is we know year to date, we have the S&P, the Dow Jones Industrial Average down 7.9%. We see the S&P as of yesterday down 10.04%. And we know that the triple Qs, or the NASDAQ, is down 13.06%. A lot of turmoil happening. And so some people might have a philosophy of saying, hey, buy the dip. When things dip down, buy it. The stock market always goes up when it goes to the right. We're going to talk about some of those status quo thoughts and what you should do about it here in a little while. Turmoil is big. The 4 T's, I have 3 solutions for you to think through. A couple of the solutions, a couple sub-points underneath them. And I know that Neil had pointed out on your sheets here, as far as on the bottom, there's those 3 numbers, 1, 2, and 3. There's going to be 3 different takeaways. So whenever we go to educate, encourage, and empower, there are going to be ways that you can basically be empowered to make some changes or have higher knowledge, and we're going to help you walk through how to do that. And so if any of those areas make sense for you, write those down so you have that information. So the first one is time, the next one is temperament, and the last one is talent. And so I would like for everyone to take their pen and their paper, to take their sheet in front of them. I want you to write out the word temperament. Don't look at the screens, write it out. You have 5 seconds. Just write it down. Don't look at the screen and look at the word. Just write down temperament. How would you spell the word temperament? So after you've done that, look at the screen and see if you misspelled the word or you spelled it correctly. I think temperament is one of the most misspelled words in the entire dictionary. I also believe that it is the #1 driver of making bad financial decisions. And we're going to walk through why I believe that. First one is time. I mentioned before, and a lot of you probably have heard this, when the market is down, it's on sale, buy in now. The market always bounces up, so buy the dip. It's about time in the market, not timing the market. And all of that is true historically. And if your time frame is greater than 20 years. The question is not, what is the market going to do over the next 20 or 30 or 40 years relative to today? The question is, when do you need to access the money that you have in the market? If you need to access the money in your investment account in the next 18 months to buy your new Jeep, and so in January you said, this is my Jeep fund, I'm going to buy my new Jeep, I'm going to buy it in the next 12 or 18 months, and then all of a sudden we went through where the market dropped, has now touched 20% down, has come back off of that. Is that more impactful to you? It is, because you may not have all the money you need to buy your Jeep in 12 months because there's not enough time for it to make up. But if your time horizon is 20 years, then yes, be opportune as far as with your investing. Instead, what I would want you to think through is, what are the time periods and what are the time periods telling us? We look at this chart. It goes way, way back to 1900. But then we see this huge drop in the gray area. That was 1929. If you look all the way to the right, how many years would it take for you to get back to what it was in 1929? You're looking at the early 1950s. 25 years to get back there. Then all of a sudden, the market moves up. It moved up from that low in the late, through World War II. We got past World War II. We had this huge upward movement. Then we get to about 1964, 1965. And the market remained flat. Had a lot of ups and downs. Remained flat till 1982. Then it dropped down again. Then all of a sudden we saw the works and the wonders of neoliberalism coming into play, of free trade, manufacturing expanding, the economy expanding. And so we had this nice upward movement. But if you look at 1964, where it topped out at 1,000, You had to wait all the way till the early 1990s before the S&P 500 got back to 1,000 points. But then it went up. We had the dot-com. Man, it just took off. All of a sudden, we got to 2000. It would take you almost 11 years to get back up to where it was at 2,700. Then we trajectory up. The market moves in long cycles. So ask yourself, do you buy the dip? Maybe, maybe not. It depends upon your time frame. Always make sure your dollars are invested according to the time frame that's significant to you, not the time frame that's presented in history. History looks at long periods of time. We need to make sure we align our finances, our investment portfolios, with when we need the money. This time period of 2000 through 2010, you see the purple is the S&P 500, the yellow is the Dow Jones, and then the blue is the NASDAQ. So over that 10-year period of time, people say, hey, stock market's averaged 10% a year. Stay in the market. Over 10 years, the total return of the Dow Jones was 27.7%. That means it averaged an annualized rate of return at almost 11 years of 2.25%. The S&P 500, for almost 11 years, the average annualized rate of return was 0.35%. And the NASDAQ was actually negative 4.43%. This is referred to as the lost decade. There's tremendous opportunity. Look at that chart. There's tremendous opportunities where you could have bought into the market and then you potentially sold out of the market and then bought back in and sold back out. You would have had a lot of money without trading continuously. 2 or 3 trades, you could have made a lot of money. Point to point, the market was flat. Okay? So, how do you combat against that? The first thing is diversification. What I would encourage you to start thinking about is what is diversification and what is it to you? A lot of people, why is diversification important? Let's say that you were 100% invested in Apple stock. Over the last 40 years, 30 years, you had huge rates of return. However, so far this year, you're down 30%. If you had 100% invested in this year and you needed money in the next 3 years, Apple stock comes down, your lack of diversification hurts you, but whenever it was screaming higher, your lack of diversification helped you. So why Apple stock? Why did you bring that up? If the United States of America continues down the path on policy of tariffs, and let's say we're going to bring manufacturing back into the United States, and so Apple, their components will no longer be manufactured because the tariffs are too high outside of the United States of America. Now we're going to bring it back into the United States of America. It is estimated that the first year, the cost of an Apple iPhone would be approximately 45% higher if it's manufactured in the United States of America instead of being manufactured in the Far East. So, why did Apple stock drop down more than what the markets did? It's because the tariffs have a much larger impact on a company like Apple than what it does on other companies. So where did the money go whenever it left the U.S. stock market? It went, among other places, to German defense companies. Really? At the same 2-week period of time, the stock market dropped 17%. German defense companies were up between 20 and 37%. Well, that's fascinating. We also know the German bond market went up in value and German currency went up. But why military companies? At the same period of time, there was pressure on both Ukraine and on Russia to end their war. But in part of the tariff discussion and part of the trade dispute discussion, President Trump also talked about how we in America can no longer be the police of the world and continue to pay for it. So miraculously, England found $700 billion for defense spending that was not in their budget the previous year. Germany increased defense spending at the same time because they knew if Russia became more aggressive, there was a threat they may have to defend themselves and not have America doing the defense for them. So whenever you hear things happening, you can get emotional because you agree or disagree. I'm going to ask you to step out of the emotion. Do not live through being so singular focused in our thoughts or also singular focused in our investment portfolio that we get hurt on returns. A lot of people look at diversification. They say I have 60% in stocks, 40% in bonds. This is an academic exercise people go through in diversification. When you take a class on portfolio management, this is a standard that is put out before you for diversification. However, in 2022, the S&P 500 lost 18.11%, and the bond market lost 13%. So if you were 60-40, you were down about 15%. What's been happening is the stock market and the bond market have been moving in tandem, and so you're not diversified. So what's true diversification? On August 16th, Stacy on her birthday, I'm not going to say what, I was going to say what year, but I'm not going to. On Stacy's birthday, she wanted to climb Mount Berstadt out in Colorado. Great. So we climbed a 14,000-foot mountain on her birthday. And that was a lot of fun, a lot of great memories, great photos. On that trip, though, we know the weather changes. So I made sure that I had sun protectant lotion for my face, sunscreen. But also, we know that the storms roll in fast, and there's rain and there's snow that come up. So we also had some rain gear. Well, why is that? We wanted to make sure that no matter what happened in the elements, that we had an enjoyable day on our climb. True diversification says, if we're going to basically smooth out the ride in our portfolios, we need to make sure that we're highly diversified. If you listen to a popular radio personality, what he's going to tell you is, to be diversified, you put 25% of your money in aggressive growth, 25% in growth, 25% growth in income, and 25% international. That's a diversified portfolio. There's this little word called correlation. What correlation means for our discussion is that how closely do those different areas move in tandem? Are they moving the same direction? Are they moving different directions? Or if you're a basketball player and you're a point guard and you're dribbling the ball, you need to make a move because the guy is defending you or the female is defending you. You want to make a move. What is a move? A move is a change in direction and or a change in pace. In other words, I was going straight, now I'm going right. I was going a little bit slower, then I accelerate real fast. Or I do both at the same time. If we want diversification, you need to make sure you understand the direction items are going and the pace in which they're going. In this case here, if you had the portfolio as described by the radio personality, which is not academic, just so we're all clear on this, you invested money into large company stocks, mid-sized stocks, small stocks, international, and emerging markets. The mid-sized company stocks, I won't go into all the math, but they move about 92% in the same way, the same direction, and the same pace as large company stocks. Small company stocks, about 90%. International, I'm diversified, I'm international. They move in the same direction 87% of the time. If you invested 20% in all 5 areas, the average cross-correlation in your portfolio is 0.83, 83%. In other words, you're not as diversified as what you think you are. Ray Dalio, who's a large hedge fund manager, and I read a lot of Ray Dalio, he says that when you're looking for the most perfect portfolio, it should be comprised of 12 to 15 different investments that are not correlated. High quality investments not correlated. So he would say large company stocks could be one, government bonds, commodities, which silver, gold, oil, copper, market neutral, which means it's not affected by the markets and what happens, venture capital, private real estate, private infrastructure, private credit, loans to businesses. If you're diversified, and let's say in this case there's 7 instead of the 12 to 15 Ray Dalio suggests, you see how they're correlated to each other, but if you split the money equally, your correlation now goes down to 0.19 or 19%. On that theory, we've been asked to private label a very similar type of diversified strategy for our clients. Working with a firm called CAS,
And they have 12 different non-correlated investments inside one packaged investment. It's a lot of the things you see there, not including large company stocks, but like private equity, investing in private businesses that are not publicly traded, or owning sports team franchises. The rules change, and now you and I can own our favorite sports team. We can be partial owners in that. But why is that significant? If you went to a baseball game 5 years ago, and then you went this year, and not the Cardinals, because they're having a horrible couple of years, but let's say you went to another team, your favorite team. Did the price of tickets go up or down over the last 5 years? Went up. The price of your hot dog, did it go up or down? Up. The price of the jersey, up or down? Up. In good times and bad times, pricing has been increasing historically in athletic team ownership. But not just the game, the distribution, the TV. The contracts found on TV are phenomenal. So if you could say, of my 12 investments, one of them is ownership in sports teams, that gives you a non-correlated investment. They're not publicly traded. But, John, if that reduces risk, am I giving up return? Well, on private equity, that'd be like if you said, hey, I want to own some of Creekmer Wealth. That's private equity. So I have ownership in a little bit of Creekmer Wealth, which you can't. But if you look at that, global private equity versus global stock market, this is the actual rate of returns of all the individual stocks in the world. The last 5 years averaged 8.9. But global private equity, investing in private businesses, made 15.7. We'll look at the last 35-year average. 35-year average, global stocks made 7.4%, which is a great rate of return. Private equity, 13.8%, less volatility on the cash flow. So what I want you to think through is, how do I diversify in a way that's not just stocks, it's not just bonds, it's high-quality investments brought together. We're rolling out in the month of May is my hope, and if you want to take the QR code or you can just write it down there, we're rolling out a separate web page of which we'll be having a lot of these different private type of non-correlated investments on there, but also we'll be having special guest speakers, which you guys have heard some of them in the past with our guests that come into our different symposium series. We'll be there, different economists will be there. They'll be speaking as far as how do you build portfolios from an academic standpoint, and how do you look at to analyze different type of non-correlated investments. So number one is time, is to make sure your time is properly allocated, your investments allocated to your own time horizon. Number two is temperament and taking action. There's two core emotions when it comes to making financial decisions, fear and greed. Warren Buffett says to be fearful when everyone is greedy, and greedy when everyone is fearful. In other words, you need to make sure you're even keel when you're making financial decisions. But that's hard to do when all of a sudden you have your portfolio and you're down $200,000 in a month. It's hard to stay grounded, isn't it? It's difficult. Think about it this way. Last Saturday we had family over for dinner, for Easter dinner. I love ham. And so I kept on going back and filling up my plate with ham. I was being greedy. Okay? That night and the next morning, my stomach was upset. I was not feeling well because I got greedy. So my emotions, my psychology, my temperament encouraged me to eat more ham. So Sunday morning, Stacy and I went after church, we went to get brunch. So we're sitting down at one of my favorite restaurants, we're getting brunch, and they had ham on the menu. I ordered the buffalo sandwich. I did not get ham. Why is that? I was kind of fearful how it was going to make me feel. So that's my behavior on my eating. Now, I'm going to rabbit trail real fast. If you're going for brunch somewhere, and I'm going to encourage you, let everyone at the table order. If this is a buffet or if they order off the menu or whatever, they can order. And whenever they say, is that all? You say, yes, but I would like an appetizer. I would like to have a large pancake for the table with lots of maple syrup. And then while you're waiting, it's like chips and salsa at a Mexican restaurant. And then while you're waiting for your food, you just have your fork in a very gross way, and your entire table is sharing the pancake. So there's no charge for that piece of advice, but just know, if you go to a restaurant and they don't have a pancake as an appetizer, it's probably not a quality restaurant. So what you want to do, though, is you want to make sure that you stay even keel and understand in your portfolios where are you at? If the markets move, you want to make sure you understand what is the risk. And so now, we've gotten extremely sophisticated and are working with a technology company that works as far as in risk assessment and correlations to make sure that every single client, regardless of whether their portfolio is managed by us, it's our 401k, maybe someone is listening is not a client of ours, they have an account somewhere else, and you want to say, hey, what is the risk that I have? If the market went through a period of time like the 1970s, which if you want to know my opinion of what we resemble the most closely, I believe where we're at right now, it most closely resembles the 1970s. And so what would my portfolio do if that environment plays out for the next decade? We now have the ability to go in and take all of your holdings, and we're able to go and project out what your risk is. Why is that significant? Because you do not want to be driven by fear or greed. You want to be acting solely based upon facts. And then you can say, John, if we had private equity into there, what does that do to my risk? If we had sports team ownership, what does that do to the overall risk? So number two, if you'll write that down if you have an interest, is to make sure that you have a proper assessment of the risk in your portfolios. If you have questions, just a reminder, feel free to text those into the phone number, 309-925-2043. And I'll wrap it up here about the next 5-6 minutes, and we'll kind of hop into those questions. Time, temperament, and talents. And so we have a tale of two talents. There's two different talents here I want you guys to look at. The first one is talent with taxes. We've identified over 120 different tax strategies that are available in the Internal Revenue Code that can help decrease your taxes. Some of them would apply to each one of us. All of them would not apply to each one of us. And so there's different tools to be used based upon your situation. We're firm believers that you pay the tax you're supposed to pay. We do not want to see a federal law named after anybody in the room. So you want to make sure you understand the code, but you're making decisions that are unique to you to help you decrease taxes. Talent with timing, I'll have Connor come up here and explain a couple of things that we're doing, because a lot of people have been asking about how have we been right as far as with the markets and where they're going. The number one request we have from our clients is tax planning to be integrated with their investment or wealth management plan. So in the spring of this year, in January of this year, we acquired a firm in Roanoke, Virginia. Their main purpose is tax planning. Brian is a phenomenal tax planner. We acquired them to start offering more in-depth tax planning. And the reason is how much you keep is just as important as how much you make. It doesn't matter what you make, it matters what you keep. And so the micro, how much do I keep this year? The macro, how much do I keep over my lifetime? The 2016 tax law change will expire or not. The tax code is simply a tool. We need to learn how to use it. Our approach is to combine planning with preparation and to make sure we have both sides taken together. So what are some of those things? You know, if you're over age 70 and a half, you can do what's called qualified charitable distributions. These are all 5 examples. We can help you set up a charitable remainder unit trust or an endowment. We now have a network of attorneys across the country to help actually set those up. Certain if you have publicly held stock or even not publicly held stock, you may have net unrealized appreciation of employer stock inside your 401k. There's different credits we can use. We can be able to put together donor advised funds, or we can start stacking 3, 4, 5 decisions out of the 120 together. It's all about accomplishing your goals in the most tax-friendly way possible. Number 3, which we've just started making available, we now have a network of nationwide CPAs that we can take your tax return from 2024. We can submit it to them. They will look over your return. They'll bring back to us, of the 120, which ones of those apply to you in your current situation. And then we can go back and say, are there ways that we can go and decrease your taxes by implementing some different tax strategies? We do have a cost for that. The cost is $300 to have the analysis done. My guarantee is, if we do not find you $300 of savings, then we refund the $300 back to you. And so I have to pay for the CPA to do the work. I would encourage you, if you have your 24 taxes done or if you're filing an extension, definitely reach out on the QR code or give a phone call to the office or text in and just get set up as far as for that tax analysis. That's the first one to work through. The next thing as far as talent is talent and timing. And inside our portfolios, we started making decisions last year. And one of the things we started working on, hey Connor, is feathering down risk. And so this chart here, I mentioned earlier, it speaks to what we've been seeing in the market. However, we simply do not look at history for the sake of knowing history. We look at to identify patterns and things that repeat themselves on a regular basis. Connor, if you've never met Connor before, he is on our investment committee. He heads up what we call our technical analysis division, in which he is looking at trends in the market to help us identify where things are moving. I wanted Connor to walk through a little bit of what we've seen and why do we make the decisions that we made, but then how does it play into your decision making. So again, if your time frame is 2 or 3 years, we may look at decisions differently in your portfolios than your time frame is 20 years. But understanding the momentum and direction, as a basketball player would, that helps you make wise, informed decisions.
Yeah, so what we see playing out here in the Cisco chart as an example is really a playthrough of exactly what that showed. So psychologically, we have habits and patterns that repeat in our lives. It starts whenever we're young, it goes through our whole life, and they continue to reoccur over and over again. The reality is we can see those emotions and realities play out in the chart. So as an example here, Cisco in the 1990s, we had the beginning growth stages. There was some disbelief, some lack of belief that this was going to continue to move up. It came down and then continued to go higher. There was hope it would be doing well. It came down again and then started to take off, and there was belief. Then in the early 2000s and late 1990s, we had this massive takeoff. This is a pattern we see happening, and it's whenever you look at the news and there's a stock and it keeps showing up over and over and over again, that is euphoria. There's excitement, there's this desire to get in and make money on the upside with it. After that, we have the pull down. Then we have a brief push up leading to anxiety and denial. Now, this is anxiety where you're hoping that you can do something to capitalize on it, that you can take advantage of it and play to the upside. What we see happening here is the large institutions, the large investors, they know our emotions, our reactions, and so they can capitalize on that, push it up, get us excited, get us having this emotion of anxiety that we're going to miss the next run up and buy in, and then they can pull down. Whenever that happens, we lead to a panic and then a larger sell-off, and then we hit capitulation. For those of you who don't know, that is a throwing down of your hands, that's a giving up, that's a saying, I'm done fighting here, and then we start to trade sideways. So Cisco is a very literal, real example we saw play out in the 90s. You can look at a litany of other stocks and see this happening across all of those. If you look at Intel, if you look at the pet.com that happened in that time period, we see this playing out over and over again. Now, fundamentally, we have a few areas that happen here. So John, if you can click to the next one. This psychological effect was portrayed by what John had mentioned earlier called the Wyckoff market cycle. There's areas of accumulation where the buyers and sellers agree on price. We've come to meet this middle point as we're trying to determine what's going to happen next. Then we have the markup. That's where price is moving higher, the buyers are taking control, the value of the stock is going up. Then we hit a settling point. That's called the distribution. Price then is agreed upon again by the buyers and sellers. Money has run out in the system to continue to push it higher. And then there's a catalyst that leads to the markdown. And that's where we believe we're at today. So John, if you switch over to the next slide, we can see that happening. So we had price moving sideways in the accumulation phase there in 2020. Next, we had the price run up. Now, we know on average the market trends anywhere between 18 and 24 months. So the bottom there was March of 2020. We ran up until January of 2022. That's 22 months. We started going sideways in that time period. And then we had the catalyst of the Ukraine war, of inflation, leading to the markdown. The other thing we see happen there is during the markup stage, we have strong, long movements, and we have slower, shorter movements. Those start happening closer to the end. That is momentum. When those movements aren't as strong, well, the reality is money's starting to run out to continue to push that higher up, leading to that distribution phase. Then, like we had mentioned earlier, we have that catalyst that we're looking for the strength on the way down, and then it happens in reverse, where we start to move sideways, looking for a catalyst again. So John, if you go to the next slide here, we see where we're at today. We had the accumulation phase there in 2022. We had our bottom in October of 22, and we've been trending higher. We reached a peak here in February of 22. Today, we're starting to see what we believe is that early stage of the markdown phase of anxiety. Prices being pushed back higher. There's this feeling of, am I going to miss the next run up? The reality is we don't make predictions and act directly on those. We let the market inform us. If we start to move sideways, we know a catalyst event will be coming, and that will either determine if we're going to push higher or lower. So what we did proactively here, John, if you go to that next slide, there's a lot of noise on this, but what you can see happened here is we had in 2023, those early push-ups, well, we had moved sideways, we broke out, and that was a sign to us it's time to raise cash. We had some strong movements before we had a sideways movement and an opportunity to raise some cash there to take advantage of that slowing momentum. Then, whenever we broke that sideways movement and started to move back up, we had a big, strong movement there up until July. At that point, we had a slowing again of movement. We raised some cash. We moved it at that point to the Dow Jones, to the Schwab. The reason we moved it there was because in times of uncertainty, industrial stocks tend to be stronger. Then we had another slower move and another one and sideways. So today we can see where we're at with that sideways movement. We're sitting in some cash here as a result of those movements. But it's really looking at that markup versus markdown phase to say, we really think we're now starting to hit that markdown, coming away from the accumulation and starting to understand that sideways movement. It's an opportunity to understand the psychology that's going on in the market and make adjustments. When other people are being fearful, we can take that as opportunities to reinvest and redeploy.
Yeah, thanks, Connor. And so a lot of what you're seeing us talk through and walk through is we want to make sure we understand the temperament of the individual investor and the market, and also why are things happening. And by doing that, we're able to make decisions that are based upon logic, based upon stats and math, and make better decisions to help you accomplish your goals. At the end of the day, everything comes down to looking at how do we take control. We can go over a lot of information, but devoid of saying how do we take control to make better decisions, well, then it's kind of fruitless as far as our endeavors to acquire knowledge. And so just acquiring knowledge is not really helpful. Acquiring knowledge with action steps is what's helpful. So number one is to say, do a tax return deep dive. With us or somebody else, I would encourage you to access our network of CPAs. They'll review your return for you. If that's of interest to you, make sure you put it down the sheet or text it over. If you'd like to talk to an advisor about that. Again, $300 on that one. It's almost not free, but that one does come with a guarantee that we'll find at least that much in tax savings. Number two is the proper risk assessment of your portfolios. So you know where the facts are as far as the risk in your portfolios, whether it's your 401k, your 403b, whether it is your 457 plan, or whether it's an account that you don't currently work with Creekmer Wealth and you have a question, what's the risk? Or if you do work with Creekmer Wealth, to ask yourself, this is the risk. What if we added some non-correlated investments on number three, the unique opportunities? And so if you want to be involved as far as our unique opportunities website, definitely put that information down. We'll connect with you here the next probably the next month or so on getting the information to where to access that and probably a separate passcode for it. And so 3 action ways you can step aside to be able to make better decisions, and it's truly about taking control. So we walk through education, encouragement, and empowerment to get us to better positions to make better decisions. I do want to open things up as far as for questions, and feel free to text those into the text line. And just so you know, I'm not checking the score of a game. I do have my little here. And Nathan, am I also on Slack as far as questions? Great. And so I'm going to hop through some of those. I know a bunch came in earlier. I want to hop through some of those and as far as questions. And Connor did mention that when we had sold out initially, we went as far as making some investments last fall into industrials, the Dow Jones, and into more developed companies for higher safety. And so a question that came in is, if your focus is on dividend growth or reinvestment, do you skip rebalancing the portfolio? And so we never skip rebalancing the portfolio. We want to make sure that when we rebalance, we don't set it on a specific date of when to rebalance. We want to make sure that we're rebalancing the portfolio from, let's say, growth into dividend players or into cash or into international based upon what the market is telling us as far as with pace and momentum. And so if the market is telling us that, we make the rebalance in the portfolio based on what it's telling us, not on a structure or set period of time. And so we're always looking to rebalance based upon what the market is telling us, what the economy is telling us. And so always keep in mind when we're rebalancing, you want to do it in a logical way that happens based upon what the market is telling us. No questions here. Anybody in the room have questions? We'll hop into these. While you're thinking of those, I'm going to go to the next question here. Yeah, Scott, great question here. Can you expand on what the difference is between a bear market and a correction as far as duration and severity? So I'll give you the academic definition. So you know how they say a recession is 2 consecutive quarters of negative growth? That's, I'll say, the media definition of a recession. The actual definition of a recession is it's a significant decrease in economic stability, GDP, with a corresponding increase in concern over employment. And so we know that in the month of March of 2020, that historically they categorized that as a recession, even though it was only for 1 month. And so it wasn't 2 consecutive quarters. So what is a bear market and what is a correction? So a bear market is when the stock market, from its high, it comes down 20% or more. So that's called a bear market. A bull market is from the low, it goes up 20% or more. A correction is whenever the stock market from its high drops down by 10% to 19.99%. So a correction, historically, is shorter, but it's sharper. A bear market will be longer and deeper. So right now, we believe we are in a correction phase. We did touch 20% down, but that's for 1 day. So that's the textbook definition versus the reality definition. And so now if the market touched the 20%, then it came back up, but then it subsequently goes down more, well, then in time we can look back and say that started the bear market. So the difference really has to do with depth and length of time. So a bear market could last for 2 or 3 years. Typically a correction is going to last for 2 months to 6 months, somewhere in there. 6 months or longer, we go more to a bear market. It's also the depth at which it goes. So this is a great question, Aaron. Thank you very much. What will the impact be if Trump fires Powell? Short and long-term negative impact. And this is a big question. So think about it this way. Markets do not like uncertainty. Markets like certainty. So if the uncertainty comes from anywhere, it doesn't like it. Now, the Federal Reserve chair is to be a nonpartisan position. We do know that presidents, for history, have exerted influence over the chairman of the Federal Reserve to get them to enact decisions regarding interest rates that would actually be beneficial from an economic standpoint to the presidency. President Trump has made some very strong statements about Mr. Powell, with his intelligence, with his being too slow, too late, always wrong. When those statements came out, what did the stock market do? Stock market went down. What did the bond market do? Interest rates went up. What did the dollar do? Dollar went down. Why? Because that creates a lot more uncertainty of what's going to happen. And so that does have huge short-term impact. Long-term impact, it may not have a significant long-term impact from an economic standpoint because some will be replaced, whether they'll make their own decisions. I do believe it would have a long-term impact on the confidence of the consumer, on the confidence of other governments, on the confidence of the investment community, on the role of the Federal Reserve and how unbiased they are. So I think it could have significant long-term impacts as far as on the how well the Federal Reserve chair is actually viewed. So that could be a huge vote. Remember, certainty versus uncertainty. That would create a lot of uncertainty. Let's see another one here. So there's a specific question as far as starting my teacher's pension. Will I be penalized tax-wise if I get a part-time job? So recognize that every state, so there's federal tax and there's state tax. Every state handles the state tax on pensions differently. So whether it's a corporate pension, whether it's a governmental pension, whether it is a pension which is given from let's say your employers, let's say you're a teacher, it's used a little bit differently than a municipal worker. So it's difficult to answer that question when we have 50 states and we have listeners tonight in 30 states. And so it's hard to answer that one specifically. What I would say on that, though, contact your advisor, have them actually run the numbers, and they'll be able to let you know for sure if you should start the pension or not, even if you're working part-time. With the given market environment, what are some of the best tax moves we could make or ask our advisors about? So I think with the given market environment, a couple things you want to do. And with the given market, as far as with equity markets, I would say if you have money inside a pre-qualified, pre-tax account, so an IRA, a 403B, right now is a great time to be moving those dollars over into a Roth account. And so when markets are down, it's a better time to move money into a Roth account because you're moving them at cheaper prices. And when they go up, they're going to move up tax-free. Also, we know that there's going to be some decision toward the end of the year as relates to tax rates. Our belief and what we believe is going to happen because of the makeup of the House and the Senate, we do believe that the tax cuts that went about in 2017, those will be extended. And so we believe the rates are going to stay the same. If you are in a upper tax bracket, one of the top 2 tax brackets, I'm not sure what's going to happen. There's just a lot of discussion on that right now. The House of Representatives, the majority leader even came out last week and said, we're the party of low taxes, so that makes no sense to me. And yet there is a growing population, a number of representatives that believe from a political standpoint it could be expedient to convey the populist message. So on that one, it's a wait and see. Other things you could be doing is to recognize if you still have large capital gains in some of your stocks, is to consider what you're giving to charity strategy. And if you give on an annual basis, should you do it as far as in a one-time dumps into a donor advised fund to receive some tax deduction? Right now, we're also looking at different tax credits that are available and trying to find ways to actually decrease taxes. So on that one, I would say I would definitely talk to your advisor or call the office. Let's get a tax analysis done and try to identify 5 to 7 things that are very unique to you. Any questions as far as from the audience? We're sitting here. Don't be bashful. We're all good? Great. Yes, Daryl. Yeah. Yeah, I actually, I did ask one of my interviewers, I said, hey, what do you view your role as? Do you view your role to be one that conveys facts to your viewers, or do you view your role to influence the minds of the viewers? What is your actual role? And I think at the end of the day, media ultimately is a business. Their role is to generate dollars and revenue. And so how do they do that? They do that by getting more eyes on them. So regardless if they're a more liberally minded media outlet or a more conservative outlet, the reality is they're all for-profit businesses. And whether they may be a newspaper or maybe print media or maybe a web-based media, the reality is they're all for-profit businesses. In order for them to get more viewership or listenership or readership, they actually have to attract people. And by communicating things in the short-term impact, it actually drives emotion, fear, or greed. And when they do that, that increase, and fear is what sells. It really is. Short-term fear sells better than anything. And so, like one of my interviewers that you saw up there said before I went on, hey, John, we need for you to communicate fear to raise emotion, but then bring people back from the brink. I said, hey, I appreciate what you need me to do, but I don't do what anybody needs me to do. We do what's right. And so I did not do that. And so I'm not sure if they'll ask me back again. We'll find out. But, and so to answer your question, Joe, I believe that what we see in the media, you need to listen to what they're saying through a quality lens and to recognize where they're coming from. they drive emotion. Emotion drives decisions. Often the times, emotions are bad decisions. That's a great example. I was high emotion to have a pancake on Sunday for lunch, for appetizer. That was a bad decision. It was a good decision in the moment, but anyway. Any other questions? I saw another hand. The light's kind of got my eyes. Nothing. Well, guys, I just want to thank you so much for participating tonight, everybody online, and everyone here. Thank you for coming. And definitely remember the 4 T's. You can definitely outrun the 4 T's with the 3 T's. But make sure you're doing it with logic, make sure you do it with knowledge, and do it with somebody beside you that can help come alongside to make good decisions. And so, anyway, as far as your sheets, make sure those turn in tonight. If you're online, make sure you follow up with text messages, and I'll talk to you guys later. Thank you very much.